Let's talk about performance first, though, because what's stunning is you've seen this massive melt-up in markets, and the hedge funds, by and large, across the industry really have not kept up. Bloomberg's all-hedge index is only up about 4.8% through the year so far, and the multi-strats, which are supposed to be the kings of the castle here, are only up less than 3% on the year. Ilana, what's going on?
Okay, so let me unpack those numbers. First off, the hedge fund index, I think, is a blend of everything. So we need to kind of go strategy by strategy to really pull out what the themes are. Long-short equities, which had a really tough 21 and 22, finally, Shonali, had performance. I am pleased to sit here and say something positive, which I have not been able to do for the last couple of years. Those funds, which are a big percentage of the hedge fund universe, the directional, concentrated, Tiger Cubs, and similar, are up as much as 20%, 30%, even 40%. The issue there, which is really important, is even though they're up that much, they still have, for the most part, an enormous high watermark to have to get out of. And let's just say it's a fund that's up 35% this year, okay? You may think, and they were down about 50% between 21 and 22, you may think, okay, year one, this year, up 35, they can get out of that remaining 15 or 20 next year, and then it's smooth sailing. But the reality is their AUM maybe was $13 billion at the beginning of 21. It's $6.5 billion now. So that 35% is on a much smaller base of capital, and it's actually as a result, so there are very much fewer dollars made than it would have been had they made that money back up before they had the losses. And as a result, there's really another 65% to go. So that's a huge headwind for that strategy.
How much more excitement is there around the industry, especially because many of them have not met the market performance still? And so even if they're up, they have two issues here, to your point, the high watermark, and the issue is you could just invest in the S&P or the NASDAQ, or even the SOX up 65% this year. How does that set them up into appetite, investor appetite for new hedge fund allocations next year?
Well, let me also touch on the multi-managers, which you cited. It is true that blended, it's not a great result, but unpacking that, there's a lot of dispersion in that result. If you look at the more established multi-managers, that have been around a while and have built a mousetrap that is very difficult to compete with, funds like Citadel leading the pack up 15%, which is a very different number than what you cited, or Millennium, 0.72, up double digits, and then the rest are struggling. And that has a lot to do, so to answer your question, LP appetite, you know, the reality is the reason the other multi-managers grew so quickly is because the more established players were either closed or very deliberate about how they grew. And if you can't allocate to the more established guys, or at least not at the level you'd like, then you end up pouring money into all these other funds that grew in the last 2 years hand over fist. And when I say quickly, I mean between 3 and 8x. Think about that. Over a 24 to 36 month period, it is very difficult to deploy that kind of capital growth and hire a winning team in order to do that. Talent is really difficult to hire and attract. No one knows that better than myself and my team. And so you can't get from 1 billion to 8 billion, hire 150 PMs, and expect a great result. There's a lot more that goes into this.